Every rise must be followed by a fall, right? For us, it's not about good or bad timing, but rather excellent or bad strategies. Black swan events and recessions are two things that we should be aware of since they have the potential to be either the worst or the best thing to happen in the world of finance and economics. Investors who risk their life savings in the stock market need solid plans to ensure their capital grows rather than shrinks. If you are at a loss for a plan of action, then you do not have one. Welcome to Financycle, where we'll help you anticipate and react to recessions and black swan events. And with that, let's get into the video. An extremely negative event that is impossible to predict, the black swan, was first defined by Nassim Nicholas Taleb, a finance professor, author, and former Wall Street trader who popularized this concept in his 2001 book, Fooled by Randomness. It's well beyond what would generally be expected of an event, and it could have devastating long-term impacts. Rare but devastating, black swan events are often viewed as clear in hindsight. One definition of a black swan occurrence is an outlier with severe and far-reaching consequences for financial markets. The impact of black swans may be seen across the entire history of the market. There have been and will be future occurrences of black swans. They are a timely reminder to get ready and diversify one's investment. According to Nassim Nicholas Taleb, a black swan event has three components. It is unexpected because no circumstance suggests its possibility. It has a significant impact, and despite its outlier status, people are likely to come up with explanations after the fact to make it seem predictable. The rise of the internet and personal computers, the September 11 attacks, and World War I are all examples of classic black swan events. Several other events, however, such as floods, droughts, and epidemics, are either improbable, unpredictable, or both. It also explains how to plan for black swan catastrophes. Preventing and minimizing loss is a key concern. Barbell strategy is something that Taleb talks about. A tiny portion of the portfolio is moved into more risky investments while the rest remains in ultra-safe vehicles. Never allocate more than 10% of your portfolio to high-risk investments. With most of the capital safe from loss during a market panic, high-risk businesses can thrive. Diversification is another method an investor can use to lessen the impact of a black swan event. While one sector of the market thrives, others typically falter. An investor with a diverse portfolio is better able to take advantage of rising markets under a wide range of circumstances. We can accept the fact that the black swan event and the recession will occur and use them to our advantage by diversifying our investment portfolio. Safe haven investments, defensive equities, value stocks, alternative investments, etc. are all good examples. A recession is defined as a significant, widespread, and long-term decline in economic activity. Although more complex formulas are utilized, a popular rule of thumb is that 2 consecutive quarters of negative GDP growth indicate a recession. The National Bureau of Economic Research, and BER, measures recessions using non-farm payrolls, industrial production, and retail sales, among other indicators, which go much beyond the simpler, but less accurate, 2 quarters of negative GDP metric. Stay tuned as we deconstruct and evaluate all you'll need to know to survive a black swan event and a recession. Before we dive into our strategies in greater detail, please like this video and subscribe for more upcoming ones. Defensive stock. The term defensive stock refers to a stock that maintains its dividends and earnings level in spite of fluctuations in the overall stock market. Defensive companies are less unstable than other types of stocks since there is a steady demand for their products regardless of the economic climate. When the economy is doing well, stocks in the consumer discretionary sector usually rise sharply. As the ups and downs of economic cycles and consumer confidence are directly tied to the performance of these stocks, we refer to them as cyclical. As individuals will always have a need for food and toilet paper, sales of consumer essentials like these tend to be pretty recession-proof. Utilities continue to see strong demand even during economic downturns, which has led to the sector's superior performance relative to others in the stock market. Large-cap pharmaceutical and medical device firms' stock prices have traditionally been viewed as defensive stocks. Undoubtedly, there will dependably be patients in need of medical attention. The main advantage of defensive stocks is that they provide similar long-term gains to other equities with far lower risk. Overall, defensive stocks have a higher Sharpe ratio than the market. This is compelling evidence that defensive equities are the superior investment option. One of the reasons Warren Buffett rose to legendary status as an investor was his preference for safe investments. Value stocks. To put it another way, value stocks are those that are currently trading at a price that is below what investors believe the stock is actually worth. Undervalued stocks are those that are currently being traded at a price that is below their fair market value. There are various causes for a stock's low price. We found that businesses that are seasonal or cyclical, market downturns, negative news, and information gaps are common causes. This investment approach is predicated on the principle of buy low, sell high. Whilst value investing has a reputation for producing huge profits, its underlying risk cannot be ignored. Investors account for a criteria known as the margin of safety to limit their exposure to risk. It's a self-imposed threshold that traders and investors use to account for potential valuation mistakes. Alternative investments. An alternative investment refers to a type of financial asset that does not fit within the traditional investment categories at times of economic or market turmoil. We are very familiar with the behavior of liquid assets, such as stocks, bonds, and credit. The alternative asset class, meanwhile, has seen trillions of dollars flow into it over the previous decade. It's unclear how they'll cope in a recession, though. How resistant are they to recessions, and how much protection can they offer against a decline in value? Finding answers to these concerns is crucial. It's not just because alternative investments have become increasingly crucial to portfolios in the last decade, but it's also because bond yields are at historic lows. Historically, bond investors have enjoyed strong downside return protection from many types of bonds, including government bonds, mortgage and municipality bonds, and A-rated corporate bonds. Because of their decreased market value and lower proportion in most portfolios, these bonds are currently unable to provide the normal return protection during the next downturn. Thus, most investors will look to alternative investments to help cushion their portfolios during the next recession. Can we expect them to succeed? Some examples of alternative investments are real estate, private equity, venture capital, digital assets, collectibles, cryptocurrencies, and real estate investment trusts. In general, such holdings have fewer ties to public equities and can serve as an excellent diversification tool. Many people choose to put their money into real estate investment trusts because of the steady income they provide. A real estate investment trust is a corporation that owns and operates a portfolio of real estate and distributes at least 90% of its taxable income to its shareholders annually in the form of dividends. Hence, a real estate investment trust can provide investors with a reliable source of income, which is especially appealing in today's low interest rate market. Yet there are risks associated with a real estate investment trust that you should be aware of before investing. Leverage risk, liquidity risk, and market risk are some of the major risk factors connected with a real estate investment trust. Investors are drawn to a real estate investment trust because they provide a way to profit from real estate without really owning any of it through dividend payments. In other words, investors can avoid the hassle and additional costs associated with purchasing a home outright. Safe haven investments. A safe haven investment is one that is thought to maintain or even grow in value during periods of market turbulence. At times when the market is unstable, investors look for places to place their investments that are less likely to suffer significant losses. The nature of the market decline, however, can affect which assets are genuinely considered safe havens. When the market is unstable, it's good to have some of your money in a safe haven. As a general rule, market fluctuations, whether up or down, don't last long. Nonetheless, there are circumstances where the market decline is more persistent, such as during recession and a black swan event. Most assets see severe declines in value during times of market turbulence. Since market system events are inevitable, some investors seek out safe haven assets that are either uncorrelated or negatively correlated to the market as a whole during times of turmoil. In a time when the value of most investments is declining, safe havens tend to hold or even gain in price. Gold has long been trusted as a safe haven investment. Because gold's value has been relatively stable throughout history, it can be used as protection against economic downturns. A bad situation that lasts for a time causes investors to flock to gold, which drives up its price due to increasing demand. At times of economic uncertainty, investors can rest assured knowing that their money is in debt instruments like a U.S. government bonds or Treasury bills, T-bills, are backed by the full faith and credit of the United States government. Since the government guarantees to return any capital invested in a T-bill upon its maturity, these instruments are often seen as a safe way to invest money. This means these assets are often sought after by investors during periods of economic uncertainty. There is a common belief that cash is the only reliable asset to hold during market crises. Nevertheless, cash suffers from inflation and provides no actual return or income. That is all there is to surviving a black swan occurrence or recession. If you had to choose one investment approach strategy, what would it be? When it comes to investing, do you agree with Warren Buffett that defensive stocks are the safest? Please share your thoughts in the comment section below. If you found this video useful, make sure to like this video and subscribe to Financycle so you don't miss any updates from us. Thanks for watching and look out for more content from us to help you invest within.